If you're watching silver prices right now, you're probably feeling a mix of excitement and confusion. Silver just shattered through $90 per ounce for the first time in human history. The charts are green. The momentum is real. The headlines are screaming historic breakthrough. But while everyone is celebrating the price, almost nobody is paying attention to what's happening behind the scenes. And what's happening behind the scenes is absolutely terrifying. I'm here to tell you that the price you're seeing on your screen is not the story. It's a symptom. The real story is unfolding in the vaults. And what's happening in those vaults right now is nothing short of a slow-motion bank run on the entire Comex silver system. In the last 48 hours, we've witnessed something that should make every investor, every trader, and every financial institution sit up and take notice. Over 4.2 million ounces of physical silver were drained from Comex-approved warehouses in a single day. That's 130 metric tons. That's not retail investors buying coins. That's institutional players loading armored trucks and cargo planes. That's smart money running for the exits. But here's where it gets truly disturbing. This isn't just about the total withdrawal. It's about what category of silver is disappearing. The registered inventory, the only silver that actually matters for price discovery, the only metal that can be delivered against futures contracts, has collapsed to just 114 million ounces. Let me put that in perspective. At current prices of around $90 per ounce, the entire registered silver stockpile backing the Comex futures market, the market that sets the global price for silver, is worth approximately $10 billion. $10 billion. That's less than the market cap of dozens of individual tech companies. That's pocket change for a sovereign wealth fund. That's a rounding error in the world of global finance. And it's draining at a rate of over 4 million ounces per day. Let's talk about what's really happening in these Comex warehouses, because most people don't understand the structure of how silver is stored and traded in the futures market. When silver sits in a Comex-approved depository, it falls into one of two categories. There's eligible silver, which is just metal sitting in storage. The owners could be ETF funds, private investors, or institutions using the warehouse as a secure storage facility. This eligible silver cannot be delivered against futures contracts. It's off the table for price discovery. Then there's registered silver. This is the crucial category. Registered silver is metal that has been specifically designated as available for delivery to settle futures contracts. When a trader takes delivery on a Comex silver futures contract, it comes from the registered category. This is the float. This is the inventory that actually backs the paper trading system. And right now, according to the latest CME warehouse reports, registered silver has fallen to approximately 114 million ounces. Now, 114 million ounces might sound like a lot. But let's examine what that number really means in the context of the market. The open interest in Comex silver futures, the total number of outstanding contracts, represents hundreds of millions of ounces of silver. Each contract represents 5,000 ounces. With open interest fluctuating around 150,000 to 200,000 contracts, we're talking about 750 million to 1 billion ounces of paper claims on silver. Do the math. The ratio of paper silver to physical registered silver is somewhere between 7 to 1 and 10 to 1. For every ounce of real, deliverable silver in the registered vaults, there are 7 to 10 paper claims circulating in the futures market. As long as most traders cash settle their contracts and don't demand physical delivery, this system works. But the moment people start asking for the actual metal, the whole structure begins to crack. And based on the data we're seeing, people are asking for the metal. Let me take you inside the vault drain that occurred in the last reporting period. The numbers we're about to discuss come directly from the CME Group's daily warehouse stock reports. These are public documents that track every single ounce moving in and out of Comex-approved depositories. In a single 24-hour period, 4.2 million ounces of silver were physically withdrawn from the Comex system. Let me help you visualize what 4.2 million ounces actually looks like. We're talking about roughly 130 metric tons of metal. That's several fully loaded armored trucks. That's cargo that requires serious logistics, security, and planning. This is not mom-and-pop investors buying silver eagles at their local coin shop. This is institutional-scale movement of strategic resources. But the truly shocking part isn't just the volume. It's who was being drained. According to the warehouse reports, the largest withdrawals came from some of the most significant depositories in the system. 1.2 million ounces withdrawn from CNT Depository, 600,000 ounces withdrawn from Asahi Refinery Vaults, 1.6 million ounces withdrawn from Delaware Depository. And the biggest number of all, 1.28 million ounces withdrawn from JPMorgan Chase. Let's pause on that last one. JPMorgan. 4 years, JPMorgan has been the 800-pound gorilla in the silver market. They've been accused of market manipulation. They paid a $920 million fine in 2020 for spoofing precious metals markets. They've been investigated, criticized, and scrutinized. But through it all, one thing remained constant. JPMorgan held the largest silver stockpile in the Western world. The market believed, perhaps naively, that JPMorgan was the backstop. The assumption was that if things got tight, if delivery demands surged, if the system came under stress, JPMorgan would have enough metal to lease into the market and calm things down. Well, that assumption is being tested right now. When you see over 1.2 million ounces leave the JPMorgan vault in a single day, it sends a clear message. Even the fortress is being breached. What's driving this exodus? Why are institutions pulling their silver out of the banking system? The answer is simple: arbitrage and fear. According to recent reports from late 2025, the Shanghai Futures Exchange has been trading silver at significant premiums to Comex prices. In some cases, spreads of $10 to $15 per ounce. When you can buy silver in New York for $90 and sell it in Shanghai or other Asian markets for $100 or more, you're looking at a 10% plus profit just by moving the metal from one geography to another. This creates a vacuum. Western vaults are being arbitraged to death. The metal is flowing in one direction, from west to east. From the discount market to the premium market. From the paper price to the physical price. But there's also fear driving these withdrawals. Smart money understands that when the ratio of paper claims to physical metal gets this extreme, the exchange has only one option if delivery demands surge: force cash settlement. Change the rules. Lock the exits. The whales are getting their metal out now while the doors are still open. Let's do some mathematics that should terrify anyone who understands how futures markets work. The registered silver inventory currently sits at approximately 114 million ounces. At a price of $90 per ounce, that inventory is worth roughly $10.2 billion. Now let's think about what that means. The entire physical backing of the global silver futures market, the metal that gives the Comex price discovery mechanism any credibility, is worth about $10 billion. Elon Musk could buy the entire registered inventory with the spare change from selling a fraction of his Tesla stock. A mid-sized hedge fund could clean out the system. A sovereign wealth fund could corner the market with pocket money. This isn't a robust market. This is a house of cards balanced on a thimble of physical metal. But it gets worse. Because that registered inventory isn't static. It's falling. According to the data, registered silver has plunged by approximately 1.7 million ounces in recent days alone. When you're losing 1.7 million ounces from a base of 114 million, you're talking about a 1.5% drain in a single day. At that rate of depletion, the registered category could be completely empty in less than 70 days. Now, will it actually go to zero? Probably not. The exchange will change the rules long before that happens. They'll raise margins. They'll limit deliveries. They'll force cash settlement. But the very fact that we can even calculate a days to zero number should tell you how precarious this situation has become. And here's what makes this truly systemic. If the current rate of withdrawals continues, it places massive strain on available registered inventory. Market analysts are now watching closely to see how the exchange manages accelerating delivery requests in the coming weeks. What happens when registered inventory drops below 100 million ounces? What happens at 50 million? What happens when the remaining metal represents less than 5% of outstanding paper claims? The answer is simple. The price doesn't just go up. It goes vertical. It goes to no offer. Because when sellers realize they're giving away a scarce physical asset for paper dollars that can be printed infinitely, they simply stop selling. The Comex has faced crises before. In March 2020, during the COVID lockdowns, we saw similar stress in precious metals markets. The London nickel market in March 2022 provides an even more dramatic example. Prices surged over 100,000% in hours, and the exchange simply suspended trading and forced cash settlements. These aren't theoretical concerns. These are patterns we've seen play out repeatedly when paper markets collide with physical reality. For decades, the United States Comex exchange was the dog that wagged the tail. New York set the price and the rest of the world followed. If Comex traders sold, prices dropped in London, Shanghai, and Mumbai. If Comex traders bought, global prices rose. That era is over. What we're witnessing in 2025 and early 2026 is a fundamental shift in pricing power from west to east. From paper markets to physical markets. From financial speculation to industrial reality. Recent reports indicate that Asian markets, particularly in China, have been consistently trading silver at substantial premiums to Western prices. We're talking about spreads of $10, $15, even $20 per ounce at various points. Why is this happening? Because Asia is where the metal is actually being used. Silver isn't just a financial asset. It's the most conductive metal on the planet. It's irreplaceable in solar panels, electric vehicles, 5G infrastructure, semiconductor manufacturing, and medical devices. China is building thousands of gigawatts of solar capacity. They're electrifying their vehicle fleet. They're dominating the global electronic supply chain. They need the physical metal. Not paper contracts. Not cash-settled derivatives. Actual silver bars that can be melted, refined, and fabricated into products. And they're willing to pay whatever it takes to secure supply. This creates an arbitrage vacuum that's draining Western vaults. When you have a $15 spread between New York and Shanghai, sophisticated traders don't hesitate. They buy every available ounce in the Comex system, take delivery, ship it to Asia, and capture that premium. This is why we're seeing 4 million ounce withdrawals. This is why JPMorgan vaults are being drained. This is why registered inventory is collapsing. The United States has become the discount window for global silver. We are subsidizing Asian industrial growth by keeping our silver prices artificially low through the leverage of paper derivatives. But physics eventually wins. You cannot print silver. You cannot create it with monetary policy. You cannot fractionally reserve it indefinitely when people actually want the physical metal. The spread between Comex and Shanghai represents something profound. It's the market screaming that Western price discovery is broken. It's a $15 per ounce signal that the paper price has disconnected from physical reality. Silver's surge to over $90 per ounce isn't just about financial speculation or trader psychology. There's a fundamental supply-demand imbalance driving this rally. And the numbers are stark. According to the Silver Institute's research, global silver demand reached approximately 1.3 billion ounces in 2024, compared to just over 1 billion ounces of supply, creating a deficit of 282 million ounces. That's not a small imbalance. That's a structural shortage representing more than 20% of annual supply. And this isn't a one-year phenomenon. The market has experienced 5 consecutive annual supply deficits totaling 800 million ounces since 2021, equivalent to nearly 1 full year of global production. Think about what that means. Over 5 years, the world has consumed 800 million more ounces of silver than miners produced. That deficit had to come from somewhere. Where did it come from? Above-ground stockpiles, ETF inventories, exchange warehouses, private hoards. We've been eating our seed corn. And now the cupboard is getting bare. The supply side of silver is structurally inelastic. Unlike gold, where roughly 75% of mining is specifically targeting gold, silver production is 75 to 80% byproduct from copper, zinc, and lead mining. This means higher silver prices don't automatically stimulate more silver production. If copper economics don't justify running a mine, that mine stays closed regardless of what silver is trading at. Primary silver mines comprise only 20 to 25% of global output. And those operations take 5 to 10 years to develop from discovery to production. You can't just flip a switch and produce more silver. Meanwhile, demand is exploding. The International Energy Agency projects solar capacity will quadruple by 2030, potentially consuming half of annual silver output. Electric vehicles, data centers, 5G networks, medical devices, every growth industry of the 21st century requires silver. The deficit isn't shrinking. It's accelerating. And here's the kicker. Comex registered inventories have declined over 70% from their 2020 peak, dropping from 346 million ounces to just 82 million ounces by late 2023, and they've continued falling through 2024 and 2025. London Metal Exchange inventories have collapsed to historic lows. Shanghai inventories hit decade lows, with over 300 tons disappearing in a single month. Every major silver exchange is being drained simultaneously. This isn't a localized shortage. This is a global supply crisis. If you think the 4.2 million ounce withdrawal is dramatic, you need to know about what happened in early December 2025. According to multiple reports, over 47.6 million ounces of silver were claimed for delivery in the first 4 trading days of December 2025, representing more than 60% of Comex's total registered silver inventory. 60%. In 4 days. This triggered what analysts are calling a vault drain emergency. It wasn't a gradual erosion. It was a run. A full-scale stampede for physical delivery. In a single day, 7,330 silver futures contracts, 36.65 million ounces, requested physical settlement, about 30% of Comex's free float. What happens when 30% of your deliverable inventory gets claimed in 24 hours? Panic. Scrambling. Emergency meetings. Phone calls to regulators. The Comex system wasn't designed to handle this level of physical delivery demand. It was built on the assumption that 95% of contracts would cash settle. That traders would take their profits in dollars, close their positions and move on. But something has changed. Traders don't want dollars anymore. They want metal. Why? Because they understand what's coming. They understand that when the ratio of paper to physical gets this extreme, the exchange has only one move: force everyone into cash settlement. And cash settlement at what price? The last printed price? A price determined by a handful of futures traders in a thinly traded overnight session? A price that bears no relationship to what physical silver is actually changing hands for in the real world? The smart money is taking delivery now. They're converting their paper claims into physical possession before the exchange changes the rules. According to reports, silver lease rates instantly skyrocketed from 0.25% to 200% annualized during periods of acute tightness, and traders immediately withdrew from the market. When borrowing costs spike to 200%, it's a clear signal. There's no metal available to borrow. The system is running on fumes. In a normal market, traders like to go home flat for the weekend. They close their positions on Friday, sleep peacefully and return Monday to a fresh market. But this isn't a normal market. And this isn't a normal weekend. When you have silver trading at $90 plus in New York and significantly higher in Asian markets, when you have vaults bleeding 4 million ounces per day, when you have registered inventory dropping by 1.5% daily, the risk profile completely flips. The risk isn't holding the position. The risk is not holding the position. Imagine you're a hedge fund manager. You're short 10,000 contracts of silver, 50 million ounces of exposure. You've been profitable for months, even years, riding the manipulation playbook. But now you see the vault data. You see the arbitrage. You see Shanghai paying $15 premiums. And you know that over the weekend, anything can happen. China could announce export restrictions. The US Mint could declare force majeure. The Middle East could buy $1 billion worth. A major ETF could face a redemption crisis. Do you really want to be short 50 million ounces going into a 48-hour market closure when the entire physical supply chain is in crisis mode? This fear drives Friday short covering rallies. The traders who are naked short will panic buy to close their positions before markets close. They'll pay any price necessary to get flat because the alternative, waking up Sunday evening to silver gapping $20 higher in Asia, is career-ending. This weekend fear is actually compounding the upward pressure on prices. Even without new fundamental news, the anxiety about what might happen while markets are closed is enough to drive aggressive bidding. Let's talk about what happens when, not if, but when, silver breaks through $100 per ounce and enters triple-digit territory. Something psychological shifts when an asset crosses from 2 digits to 3. It's not just a number. It's a perception change. It's a signal to the world that this asset has fundamentally repriced. At $99, silver is still a volatile commodity. Something you trade. Something that's expensive. At $100, silver becomes something else. It joins an elite club. It gets attention from family offices, pension funds, and sovereign wealth funds that wouldn't touch it at $30. The unit bias kicks in. Human psychology is weird this way. We perceive $99 as cheap, but $100 as a major milestone. Retail investors who wouldn't buy at $90 will rush to buy at $110 because the breakout confirms momentum. But here's where silver defies normal economic laws. In most markets, higher prices destroy demand. If gasoline hits $10 per gallon, people drive less. If beef hits $50 per pound, people eat chicken. But silver, and precious metals generally, exhibit what economists call the Veblen effect. This is a rare phenomenon where demand actually increases as price rises, because the high price itself signals value and desirability. Think about luxury goods. The Rolex, the Ferrari, a Hermes bag. People don't buy them because they're cheap. They buy them because they're expensive. The high price is part of the appeal. It's a signal of wealth, taste, and exclusivity. When silver hits $100, it stops being a cheap industrial metal and becomes a monetary asset. The price itself becomes a marketing campaign screaming to the world, "This is valuable. This is real money. This is what sophisticated investors are buying." This creates a self-reinforcing cycle. Higher prices attract more buyers. More buyers push prices higher. The breakout creates the fear of missing out. FOMO drives retail panic buying. And remember, this retail panic is hitting a market with zero available supply. The US Mint has had ongoing supply issues. Dealers are rationed. Premiums on physical coins and bars have been spiking. The vaults are empty. You have infinite demand meeting zero supply. That doesn't create equilibrium. That creates a melt-up. So where are we headed? What are the realistic targets for silver if this supply crisis continues to unfold? Let's look at the gold-silver ratio for context. The gold-silver ratio reached 90.3 in December 2024, which is high by historic standards. Throughout most of history, the natural ratio has been closer to 15 to 1 or 20 to 1. Gold is currently knocking on the door of $5,000 per ounce. If we apply even a conservative 20 to 1 ratio, that implies silver at $250. At the historic 15 to 1 ratio, we're looking at $330 per ounce. Does that sound crazy? Maybe. But consider this, silver was priced at just $28.92 per ounce on January 1, 2025, and by this week it reached $81.27 per ounce, an increase of approximately 180% in just over a year. We've already seen triple-digit percentage gains. Silver has already broken every assumption about where it should be trading. The 1980 high of $50 has been obliterated. The 2011 high has been surpassed. We're in uncharted territory. And the fundamentals driving this move haven't changed. The supply deficit is structural. The vault inventories are still draining. The East-West arbitrage is still pulling metal out of Comex. China's export restrictions are still in place. Industrial demand is still growing. Every factor that pushed silver from $28 to $90 is still operative. In fact, many of them are accelerating. What stops this rally? What brings prices back down? In a normal market, you'd expect higher prices to bring out sellers. Mine supply would increase. Recycling would surge. ETF holders would liquidate for profits. But we're not in a normal market. Miners can't produce more because 75% of silver is byproduct. Recycling can't fill a 280 million ounce annual deficit. And ETF holders, the smart ones anyway, understand that they're holding claims on vaults that are being drained. Why sell now when the squeeze is just beginning? The traditional mechanisms that would normally cap a price spike aren't functioning. The supply is inelastic. The shortage is structural. The paper market is breaking down. So what should you do with this information? How should you position yourself for what's coming? Let me be very clear. I cannot give you financial advice. You need to make your own decisions based on your own situation, risk tolerance, and investment goals. But I can share some considerations based on the data we've examined. First consideration, the nature of your holdings. If you own paper silver, futures contracts, unallocated pool accounts, or certain ETFs, you need to understand the counterparty risk you're taking. When push comes to shove, when delivery demands surge, exchanges can and will force cash settlement. Your paper claim could be converted to dollars at a price that bears no relationship to what physical silver is trading for. Physical possession eliminates counterparty risk. Allocated storage with proper documentation creates a legally enforceable claim to specific bars. These are different animals than paper contracts. Second consideration, the long-term view. While taking profits is natural after a 180% gain, consider what you're exchanging silver for. You're trading a physical asset with industrial utility and monetary properties for fiat currency that's being printed by the trillions. The United States government is running multi-trillion-dollar deficits. The Federal Reserve's balance sheet has exploded. Every developed economy is monetizing debt. In that environment, is locking in paper profits really a win? Third consideration, asset rotation strategy. Some sophisticated investors hold precious metals until they can be exchanged for income-producing assets. They wait for the mania phase to overshoot, then rotate into real estate, businesses, or dividend-paying stocks. They watch the silver-to-real estate ratio. They wait for the moment when an ounce of silver can buy significantly more property than it can today. That's the exchange they're waiting for. Fourth consideration, managing volatility. Markets that move up 180% can also have brutal corrections. Leverage is dangerous in volatile markets. Avoid high leverage positions. Avoid margin calls. Avoid being forced to sell at the worst possible moment. The volatility is the noise. The trend is the signal. If you believe in the structural supply deficit, if you believe the vault drain is real, if you believe Eastern demand will continue, then short-term price swings are just opportunities to add to positions. But here's what I know with certainty. We are living through a historic moment in silver markets. The combination of multi-year supply deficits, collapsing exchange inventories, east-west arbitrage, and industrial demand growth is unprecedented. The registered silver stockpile backing the Comex futures market has collapsed to levels that threaten the entire price discovery mechanism. We are witnessing a slow-motion bank run on the paper silver system. Here's what we know. Comex vault inventories have declined by over 73% since 2020, exposing systemic vulnerabilities in the physical silver market. In recent days, 4.2 million ounces were withdrawn in a single day. In early December, over 60% of registered inventory was claimed in just 4 trading days. The ratio of paper claims to physical metal is blowing out. The arbitrage vacuum is draining Western vaults. The East is setting the price. The paper market is losing control. Silver at $90 isn't a bubble. It's a correction to fair value. It's the market repricing a strategic industrial and monetary metal that has been artificially suppressed for decades through paper derivatives and leverage. The moving goalposts keep moving. What looked like resistance at $50 became support. What looked like a ceiling at $75 became a floor. Every level that skeptics said was too high has been surpassed. Why? Because the fundamentals are overwhelming. Because you cannot paper over a physical shortage indefinitely. Because eventually, physics wins over financial engineering. The banks that have been short silver for decades are facing their reckoning. They're not just fighting retail buyers or momentum traders. They're fighting global supply chains, industrial demand, sovereign wealth funds, and the entire arbitrage network moving metal from cheap markets to expensive markets. You cannot win that fight. Not with paper. Not with derivatives. Not with regulatory capture. Eventually, the physical metal is either there or it isn't. And right now the vaults are screaming, it isn't there. The triple-digit era is here. Welcome to the new reality. The era of cheap silver is over. The era of abundant silver is over. We are entering the era of scarcity, of physical tightness, of paper market breakdown. The question isn't whether silver will hit $100. The question is what happens after. Stay informed. Watch the vault data. Follow the registered inventory. Track the east-west spreads. The numbers don't lie. The silver bank run is real. And it's just getting started. If you found this analysis valuable, share it with others who need to understand what's happening. The mainstream financial media won't tell you this story. They're too busy celebrating price milestones without examining the structural crisis underneath. The truth is in the data. The truth is in the vaults. And the vaults are being emptied. Thank you for watching. Stay safe, stay informed, and hold the line.